Good morning. Welcome to the B.F. Anderson Technical Report for October 24th. This is a very interesting report done by Morgan Stanley. Basically, expect 15 more years for the bull market if demographics are destiny. What the graph is showing, it's a bar graph, and it's showing that different ages of human behavior cause certain types of consumption. So if you notice here, that the consumption years really get started when the age groups hit age 35. That's when people start buying houses, and you notice that they spend most of their money at age 35. You may want to pause this on your video player just to look at this graph for a minute, because it is quite interesting that the major expenditures were for housing and for transportation. Now, this is important because the millennials, which have now exceeded the baby boomers in population size, there are 84 million millennials, whereas we currently have 74 million baby boomers, and the baby boomers' average age right now has hit 54, which means that the baby boomers are now tailing off of their spending cycle. In other words, the house is renovated, the furniture's bought, everything that one would want in life is pretty much accomplished by age 54, whereas in age 35, you're just getting started. This is very important. I'm going to get to this in the report. I show a graph later in the report that talks about this and the implications for the stock market. But basically what we're seeing here is that as the population changes with age, consumption patterns change, and it's really important to understand how demographics affect the stock market. But let's get into what's going on currently. As you can see, the Nasdaq continues to basically move sideways. We're getting like a little bit of a moving average spaghetti here, where we're getting a lot of tangle, not a definite trend. This market, if at best case scenario, is basically moving sideways. Now, as we look at the weekly graph, which is kind of an important graph as well, we have continued to hold the 35-week moving average. 35-week moving average is in an uptrend. Now, what we're also going to talk about here is what is driving this market. Now, this is a new indicator that I introduced last week that I've kind of taken to the next step. I want to really make a very important point here. This is a ratio. I'm comparing the Nasdaq to the XLP, which is I'm comparing the Nasdaq to consumer staple stocks. So in other words, you know, people will, the market will start to favor the value side of the market, or the value investments versus the growth investments. So with Nasdaq, you're looking mainly at technology. With consumer staples, you're looking at products that people have to buy: toothpaste, toilet paper, just things that are necessary in everyday life. So when the market starts to favor that sector, it really is somewhat of a warning. Now, if we go back to 2000, and what I've done here is I've done some back testing on this, and have determined that the best way to look at this is using a weekly graph where we compare the 10-week moving average to the 40-week moving average. Now, I've removed the ratio. The ratio is not on this graph. I've made that invisible, and I'm showing only the moving averages, and what we're looking for are golden crosses and death crosses. So you can see here, back in the bear market of 2000, you got a death cross here where the Nasdaq started to underperform the staples, and you can see what happened. Really bad things happened after that. Then the market made a low, and we got a golden cross on the technology stocks, or the Nasdaq, starting to outperform the staples. So there was your market bottom, and we just basically floundered around here. Now we got into 2007. You can see the same death cross that happened prior to, or right on top of, the financial crisis. So you can see again the Nasdaq underperforming the staples. Then the market made a low in 2009, same story. Now in 2016, we saw a resurgence of the Nasdaq outperforming the staples. We got a nice up move But here recently, which really started in the mid part of 2018, around June of 2018, we started to see where the Nasdaq started to underperform the staples, and we are on a death cross for this indicator, which tells me that the market is not wanting to take on risk, that this is a risk-off market, therefore we need to be cautious. Now here's the same graph where I've just kind of shortened the time span. Also here at the bottom I'm showing a comparison just to make the point of Facebook compared to Procter & Gamble, and you can see here right around June of 2018 stocks like Facebook, Amazon, Microsoft, just all the growth names started to underperform Procter & Gamble, which is a consumer staples. So you can see here on this graph here that you go through periods where growth stocks underperform. This was 2014, 2016. A lot of people would have given up on that growth strategy right here, and that's when it turned. So you got a turn up. Now, where we are today is we like I say, we peaked around June of 18, underperformance, moving sideways. Now, what we want to see is where this particular ratio, because the ratio's on this graph, you want to see where that ratio gets back above that lower moving average, and that lower moving average turned up. It just hasn't happened yet. Now on the advanced decline line, continuing to see a general improvement here. Now realize this market is being driven primarily by the consumer staples. Now if you notice something like an Apple computer, Apple's making new highs. The phone is something like a staple. I mean, it's something you got to have. Everybody has their cell phone. Now on new highs and new lows for the New York Stock Exchange, we're in pretty good shape here. No major warnings on that indicator. Now on the long-term graph, which is where we use the 10-20 moving average, this is a monthly graph, you can see that the market is close to making a new high, but I have to tell you it is being driven not by technology stocks, it's being driven by stocks that are somewhat defensive in nature. However, the overall market looks very healthy. Here's another graph, another long-term graph where we use a weekly graph and we're comparing it to the 200-week moving average. Looks healthy. Everything's in an uptrend. Again, we're going through this rotation. I can't repeat that enough. This is the global Dow. Again, the international stocks continue to move sideways. Nothing really to report there. On the value line geometric, which is an equally weighted index, very important. I would say the most important thing to realize is that in technical terms, resistance, 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 and does resistance become support? In other words, people get accustomed to this price level so that every time the index pulls down to this price level, it holds. So far, the value line has held support at 523. That's very positive. Now on sentiment, I kind of made some changes here. I went to a different graph. I'm using the American Association of Individual Investors, the people that were polled last week that were bullish, minus the people that were bearish, and you end up with a final number of 2.5, which is somewhat of an improvement, meaning that people are becoming less pessimistic. But at the same time, you can see here that when you get, like, for example, here's the low last year, you can see what happened. Pessimism was out the door, pretty much very, very negative. Now, right now, we are continuing to see a lot of pessimism, but the indicator has moved back to somewhat of a neutral stand. Now, this is a graph, and I apologize here for the size of the graph. It's not fitting on here like I would like, but anyway, let's take a look at it. This is a graph going back to 1980, and this is to talk a little bit more about the demographic study that we talked about at the beginning of this video. In 1982, the baby boomers hit the sweet spot at age 35. So the average baby boomer was 35 years old in 1982. They hit their consumption peak at age 54. Well, that's where the market peaked as well. Now, the millennials, which we're now seeing 84 million millennials, which is outnumbering the number of baby boomers, hit the sweet spot right here in 2016. So the question here is, are we going into a consumption cycle where the where the millennials are going to lead the charge? Now, one thing you have to realize here, and I wanted to point this out, is something called recency bias. The reason back here, now if you go back here in 1982, 1983, the Dow broke 1,000 for the first time since 1966. So from 1966 to 1982, the market basically moved sideways. In fact, Business Week, on the cover article of Business Week in 1982, they had the cover article was the death of equities. In other words, everyone, after an extended period of time of the market doing nothing, pretty much had given up on the market, and lo and behold, that's when we broke out and went into an 18-year bull market. Now, one thing to note is it's not a straight line. That you had difficult periods in here. This was the crash of '87, but I've also got the 200 week. This is a weekly graph. That's the 200-week moving average. You can see that the market got way extended above the moving average. Therefore, the correction in '87 was just an excess correction where the market got too high. Then we resumed the uptrend. The uptrend lasted 18 years, then peaked in 2000, and we've been moving sideways ever since. Then in 2016, we're breaking out, which is right here, which is basically coincidental with the fact that the millennials are reaching age 35. Then last year, we had somewhat of a correction that kind of looks like the crash of '87 in a way. The market just got too extended. Now down here, I'm showing a index or an ETF for the home builders. So you can see here that the home building stocks are definitely in an uptrend. Now the top 5, Medicines Corp. This continues to look good, very positive pattern. I do have to emphasize we own this stock. It is a risky situation because the company has no revenues, but they've got a blockbuster product that is awaiting FDA approval. And if they get the approval, and it looks pretty positive to me, this could be an interesting deal. Is risky though. This is Pod, which is Insulet Corp. This is a company that has a technology having to do with the treatment of diabetes. You can see though that the stock is somewhat rolled over, broken below the 50-day moving average. I would continue to watch this stock. It is really not a buy at this point. Restoration Hardware, what they now call themselves RH Corp. Nice, powerful uptrend. Again, this is home renovation. We're seeing a lot of interesting activity in the home building area. This is Seattle Genetics. They just announced a test results on a drug that has to do with treatment of cancers. They modified an existing drug, and you can see the breakout, the gap up, heavy volume, something to keep an eye on. This is Target. Again, we're seeing things like retail and home building is kind of one of the areas that is strong. Target, again, is in a nice uptrend, had a nice gap up here. However, did break down below the 10-day moving average, so I would just keep an eye on it. So all in all, what I'm saying is pay attention to demographics. This is very important. If we go into a consumption cycle where the baby boomers start buying in big way at age 35, and it's not projected that buying cycle will peak until age 54, we're looking at a 15-year bull market if destiny, if demographics is the destiny. If you have any questions, give me a call. Thank you.